Picture the last Dick's Sporting Goods store you walked into. Now erase that image from your mind completely. Because the stores this company is building right now look nothing like that. And that difference, ladies and gentlemen, could decide the entire future of this stock. Today we're talking about ticker DKS, Dick's Sporting Goods. And if you've been writing this off as just another boring retail name, you're about to miss what Wall Street analysts are quietly calling one of the most dramatic retail transformations in a decade. Stick with me to the end of this video, because I'm going to break down exactly what House of Sport is, why institutional investors are accumulating shares, and the specific numbers that suggest this stock could deliver outsized returns over the next 3 to 5 years. Let's get into it. First, the setup. Most investors, especially growth-focused investors in their 30s, look at DKS and see a legacy big-box retailer. They see foot traffic, inventory risk, and Amazon pressure. They move on. And that, according to multiple Wall Street analysts, is exactly the mistake. Because while everyone was distracted by Nike's struggles and Lululemon's slowdown, Dick's was quietly executing what management calls the most important strategic pivot in the company's history. That pivot has a name: House of Sport. Here's what you need to understand. A traditional Dick's store is roughly 50,000 square feet. It sells equipment, apparel, and footwear in a fairly standard retail layout. House of Sport, on the other hand, is 100,000 to 140,000 square feet. That's nearly triple the footprint. But the square footage is not the story. The experience is the story. Inside a House of Sport location, you'll find a rock-climbing wall, a batting cage with hitting simulators, a putting green with shot-tracking technology, an outdoor turf field for cleats testing and youth events, a running track for gait analysis and shoe fittings. There are licensed health and wellness services in some locations. There are local pro-athlete appearances. There are youth sports leagues hosted on site. This is not a store. This is, according to the company's own framing, a sports community hub. And here is the number that should make every growth investor pay attention. According to company disclosures and recent analyst reports, House of Sport locations are generating roughly 2 times the sales per square foot of a traditional Dick's store. Some analysts have reported figures even higher than that. We're talking about revenue per location that, in some cases, exceeds $35 million annually. That's a staggering productivity uplift in a retail environment where most chains are fighting just to hold flat comps. Now let's talk about the rollout. As of the most recent updates, Dick's is operating a growing footprint of House of Sport stores across the United States, with management guiding toward 75 to 100 locations by 2027. Wall Street estimates suggest each new House of Sport could contribute meaningful incremental EBITDA, and if the company hits its build-out targets, we're looking at a potential multi-billion-dollar revenue layer being added on top of the existing business. But there's another concept you need to know about: the Field House. This is a smaller format, roughly 50,000 square feet, designed to bring House of Sport DNA into markets that can't support the full footprint. Think of it as the scaled version. Same experiential focus, same community engagement, but in a more flexible package. Management has indicated that Fieldhouse locations are also outperforming legacy stores on key productivity metrics. This gives Dick's 2 parallel growth vehicles, and that's something most investors completely overlook. Now let's talk about the financials, because the story only matters if the numbers back it up. Dick's recently delivered comparable sales growth that significantly outpaced the broader retail sector. Net sales crossed $13 billion on a trailing basis. Operating margins have expanded meaningfully from pre-pandemic levels. The company has been buying back stock aggressively. It pays a dividend that has been raised consistently. and the balance sheet remains strong with manageable debt levels. According to recent filings, free cash flow generation has been robust enough to fund the experiential rollout without compromising shareholder returns. Wall Street price targets have been creeping higher throughout the year. Several major firms have raised their targets, with bull cases pointing to meaningful upside from current levels based on the experiential store thesis playing out. The bear case, of course, exists. Consumer spending could weaken. Sporting goods is discretionary. A recession could hit. These are real risks. But the structural shift toward experiential retail is not a cyclical story. It's a secular one. Let me give you the macro context, because this matters. Younger consumers, particularly Gen Z and millennials, are spending less on goods and more on experiences. That trend is well documented. Now ask yourself, what happens when a retailer figures out how to merge the two? What happens when buying a baseball bat also means hitting in a simulator, getting fitted by a coach, and joining a local league? That's not retail. That's experiential commerce. And Dick's may be the first national big-box retailer to truly crack the code. There's also the youth sports angle. Youth sports participation in the United States represents a market estimated in the tens of billions of dollars annually. Parents are spending more than ever on travel teams, equipment, and training. House of Sport positions Dick's right in the middle of that ecosystem. They're not just selling cleats. They're hosting the tournaments. They're providing the fittings. They're becoming the destination. Now, let's talk about who else benefits from this thesis, because smart investors think in ecosystems. First, Nike, ticker NKE. Dick's is one of Nike's most important North American wholesale partners. As House of Sport drives higher engagement and premium product mix, Nike benefits directly. Analysts have noted that the Dick's relationship has become increasingly strategic for Nike as the brand recalibrates its direct-to-consumer strategy. Second, On Holding, ticker ONON, and Hoka, owned by Deckers, ticker DEC. These premium running brands rely heavily on specialty retail distribution. House of Sport's running track and gait analysis capabilities make it a natural showcase for premium footwear. The halo effect is real. Third, the broader experiential retail theme. Companies that successfully blend physical experience with commerce are commanding premium valuations. Dick's, if it continues to execute, could see its multiple re-rate to reflect that experiential premium rather than its current legacy retail multiple. That multiple expansion alone could be a major driver of returns. Let me address the elephant in the room. Why hasn't this story been priced in already? A few reasons. First, the rollout is gradual. The market tends to underweight stories that play out over years rather than quarters. Second, retail as a sector carries significant skepticism, and many institutional investors have a blanket aversion to brick-and-mortar names. Third, Dick's doesn't fit neatly into a growth bucket or a value bucket. It sits in between, which means it gets overlooked by managers on both sides. That's the opportunity. When a story is too slow for momentum investors and too transformational for traditional value screens, that's often where the best multi-year returns hide. Here's how I'd frame the setup for you. If House of Sport stores continue to deliver roughly 2 times the productivity of legacy stores, and if the company hits even the midpoint of its rollout targets, Dick's earnings power 3 to 5 years out could be meaningfully higher than current consensus estimates suggest. Combine that with potential multiple expansion, ongoing buybacks, and a growing dividend, and you have the ingredients for a total return story that few investors are positioned for. This is not a story about Dick's being a great retailer. This is a story about Dick's potentially becoming something different entirely. A community platform. An experiential destination. A brand that owns the youth sports journey from purchase to participation. That's the bet. Of course, execution risk is real. Building 100 massive experiential stores is hard. Staffing them, programming them, and maintaining the experience at scale is harder. Management has so far executed well, but the next 3 years will test that thesis. Watch comparable sales trends at House of Sport locations. Watch new store productivity metrics. Watch how the Fieldhouse format performs. Those are your key indicators. So here's the bottom line. The Dick's Sporting Goods that lives in your memory is not the Dick's Sporting Goods that the company is building. House of Sport is a fundamentally different business model wrapped inside a familiar ticker. And while most investors are still treating this as a legacy retail name, a quieter group is positioning for what could be a multi-year transformation story. Please take a careful look at the names we covered today, do your own deep research, and I wish you all successful investing. If this kind of breakdown was useful to you, please hit subscribe and like so I can keep bringing you deeper investment ideas like this one. As always, all investments carry risk, and final decisions are your own responsibility.